Good afternoon, everyone. Thanks for joining us for another Apt Wealth Partners event. My name is Matthew Dunbar, and alongside my colleague Rob, we'll be taking you through some practical end of financial year strategies to help you maximise your wealth. Today is really about giving you some clear, actionable ideas to help you consider before 30 June, but it's also about helping you think more strategically beyond just this financial year. We'll start with a quick disclaimer. So the information we're covering today is general in nature, doesn't take into account your personal circumstances. We recommend seeking personalised financial advice before making any decisions. For those who I haven't met, I'm Senior Financial Advisor and Head of Advice here in Victoria. I've worked across banking and accounting environments for about 15 years nearly, and just about to tick over 10 years at Apt. I really enjoy working with clients to understand what's important to them, help align some strategies towards their long-term goals. I'll throw over to Rob to introduce himself.
Thanks, Matt, and great to be presenting together today. I'm Rob Greig, Head of Advice for New South Wales here at Apt Wealth Partners, where I've worked for close to 9 years. My focus is working with individuals, couples and families, often at important decision points, and whether that's building wealth, preparing for retirement, or navigating events like an inheritance and intergenerational wealth transfer. What I see consistently is that people don't lack options. They lack clarity around which decisions are most effective. And that's really the purpose of today, is helping you focus on what matters most heading into the end of financial year and where the key opportunities sit. And before we get into the content, just a couple of quick points on how we'll run today. We're scheduled for around 1 hour, and we'll work through the key end of financial year strategies. Please ask questions throughout, and we will answer as many questions as we can after the presentation. As we go through, I'd encourage you to think about what's relevant to your own situation, because the value is understanding which of these strategies may apply to you. I encourage you to reach out to your existing Apt advisor for the existing clients on the call, and Matt or I if you're on the webinar today and are yet to engage Apt for professional, expert, personal advice. The key point up front is that while timing matters and acting earlier often gives you more flexibility, it is also important to ensure your plan is working cohesively together from a holistic perspective. The recording of today's session will also be sent to you as well in the coming days.
Thanks, Rob. We'll get started with some of the key tax planning, given some of this is quite critical pre-30 June. And there's two main levers you can pull, which are bringing forward deductions or deferring income where appropriate. And we'll cover a few of these key ways to do this today. Now, while we all want to minimise our tax wherever possible, it's important to remember that most tax deductions come thanks to an expense. And in the best cases, you might get 47% of that expense back. Most people more likely to get about 30%. And tax savings shouldn't be your primary driver. You want the best net cash flow outcome, best financial outcome, and creating $1,000 expense just to save $300 or $400 still leaves you worse off than where you started, unless that was actually an expense that you needed to go through. And we see it all the time with people buying a car for the sake of it just to get that discount. So it's making sure you're getting realistically things that you need out of that. The ATO has a number of areas that cause red flags, so it's important to make sure you have receipts and proof in order to make sure you have some of these key areas covered off. And a couple of the key ones would be for individuals, work-related expenses, particularly now that we're starting to work from home a little bit less than we were over the last few years. It's a key one that they're really hitting quite regularly. People over-claiming expenses on investment properties, trying to put through works on their own home that were actually, trying to say it was for the investment property. Small businesses, if you run a small business and you're putting personal expenses through it, they are looking into that quite a lot now. This one will change a little bit with budget, but you've got, if you have family trusts and things like that, it's actually letting that flow through to the nominated parties, particularly where you're using people on lower tax brackets. There was a recent ruling that just came out today, though, that sort of says that that's not as bad as it was, but we sort of won't go through that part of it today. But yeah, being careful about where you're actually distributing this to and making sure that the intended recipients are sort of getting it. And then with crypto on the rise as well, the ATO's got better data matching tools for this now as well. So being honest about what's going on, you don't want them coming at you later on. They're not the most lenient bunch when things go wrong. So reviewing your work-related expenses, your investment costs, any education costs, home office claims, all those sorts of things, really important. But then trying to use different offsets and rebates effectively as well. And we see it all the time. And to be honest, I hate this too, but private health insurance is a big one. And for singles earning more than 101,000, couples on more than 202, you're going to cop a surcharge if you don't have the private health insurance. And sometimes just having a very basic policy is more cost effective than copping that surcharge. So making sure you've got that sorted. And then one of the other offsets, sort of a lesser known one, it's often missed, but it relates to your superannuation, and you can make a spouse contribution. So basically, you can put in up to $3,000 into your spouse's superannuation and get a $540 offset, which is basically $540 if you're tax paid or an extra $540 refunded. So it's effectively a guaranteed 18% return. Now, I don't know about you, but there's not many places I know of where you can get a guaranteed 18% return. So if we can do that, it's a pretty damn good way of going about it. There are rules around it. You've got to make sure your spouse is earning under 40-odd thousand a year. So there's a few things to work through on that. But I think that's one of the key things that, there's different rules and they might not seem much, but when you add them all together, they can have a big impact. So on the super, that probably segues quite nicely to Rob, who's going to talk on the next slide a bit about superannuation.
Thanks, Matt. So yeah, just to reiterate that super remains one of the most effective structures for long-term wealth creation, largely due to the tax environment. So from an end of financial year perspective, there are a few key areas to focus on, and I'll kind of go through some of the various contributions and why it's so important in terms of your wealth plan over the long term. So starting off with what we call non-concessional contributions, sometimes referred to as after-tax contributions. They have an annual cap of $120,000 this current financial year. And with some of these numbers, as we'll go on further in the session, they will be changing as at 1 July. So these are the current numbers. In terms of non-concessional contributions, there's also the opportunity to use what's called the bring forward rule. And that's where a person can use up to 3 years worth of that contribution cap in one go. So that totals $360,000 under the current cap, which again is a meaningful amount that can be moved into a tax-friendly environment, especially considering some of what's been proposed in the budget this year. There are a number of restrictions that we've still got to be aware of in terms of largest total super balances and being under the age of 75, so quite a lot of age-related caps and so on with a lot of these contribution strategies. One kind of quite important thing to note in terms of this current financial year is that if you trigger the bring forward rule in this current financial year, you won't get the benefit from what's being proposed from 1 July onwards, where the cap amount will increase to 130,000. So again, part of what our clients will be aware of in terms of our recommendations and what's being considered. Concessional contributions, so these are especially timely if you are a taxpayer and you essentially have a personal tax rate above 15%. The annual cap each year currently is $30,000. Again, will index from 1 July. But essentially, if you have the cash flow, you've been able to get on top of any non-deductible debt and so on. Often, this can be a very effective kind of wealth accumulation tool where you will pay 15% tax on the contribution inside super, but you'll net that tax benefit. So you can imagine for the highest marginal taxpayers, the benefit is considerable. Further to those concessional contributions, we also have what's called catch-up concessional contributions. Again, there are a number of rules around these, so please check and get professional advice before implementing anything. But essentially, if you have your total super balance under $500,000, as at the end of the 30 June from the previous year, you're able to go back and use any unused amounts on up to the last 5 years. And again, if you have, under current rules, like a significant capital gain, these can be very, very valuable to utilise. And it's also a bit of a use it or lose it. So you're going to lose the 5th year as it passes. So typically, if you do use some of these catch-up concessional contributions, it's automatically applied to that 5th year. But again, it is something to be aware of. And I find that the data is getting better and better through MyGov, so you can check the history with relative ease these days. Alongside those contribution strategies, something that we often look at for clients is whether recontribution strategies are also appropriate. These are generally used to reduce any death benefit tax liability where appropriate within superannuation. And then there are kind of other variations of this strategy that we put forward to clients as well in terms of maximising Centrelink entitlements and proportioning funds with a future view and context around their own caps and so on. We've also got downsizer contributions, which have been around for a few years now. So many people have used these, or many clients have used these, and they are becoming more prevalent. Essentially, as a single, you could contribute $300,000 from the sale of your home, again, for the number of other eligibility. And if you're a couple, there could be $300,000 each. So combining the bring forward rule that we mentioned before from the non-concessional contributions and a couple doing $300,000 each without even considering any concessional contributions, you're able to tip over 1.2 million into superannuation, which, as you can imagine, can have a huge effect on kind of your future retirement, and having that investable assets creating income to support your retirement as well. As Matt mentioned before, you've got things like spouse contributions and also government co-contributions for our lower income payers, or lower income thresholds. And essentially, especially after the budget, which again, as I said, we'll go through in more detail in due course, the goalposts are narrowing, and superannuation and the home still are very tax effective places to invest and important kind of parts of your wealth accumulation. Even with the additional taxes above 3 million and 10 million, it often, not in every case, but it often is still tax effective to hold money. And I think as part of this, as we've said all along, seek personal and professional advice, which is specific to your own situation. Because anyone that made kind of knee-jerk reactions around Div 296 when it came in, which was those balances above $3 million, after this recent budget, again, suddenly that's still looking quite effective to be paying a bit of extra tax on those higher super balances as well. So I suppose the key takeaway from this slide is it's not just contributing, but being deliberate on how the contributions are structured and timed. A holistic view is important, and to ensure you understand the importance of the timing and not tripping up over any relevant caps due to incorrect sequencing. So, for example, we triggered the bring forward rule, the client's balance goes over $500,000, and then they lose the ability to make those catch-up concessional contributions in future financial years. So again, that's where your Apt Advisor comes in, is ensuring that it's not just in that current financial year, but you have a solid plan moving forward and you understand things from a holistic perspective. In terms of preparing for some of the upcoming super changes, again, we'll go through this in more detail, but almost all the contribution caps are increasing, and the transfer balance cap, which is the amount that's transferred from your accumulation into an account-based pension, is also increasing as well. So these are just some of the items to be aware of fit with your own financial plan.
Thanks, Robert. It's a good point. There's the thing about saving as much tax as you can now, because all of these rules work on a financial year basis. In most cases, you're looking at it going, I can save as much tax as possible now with some of these, but it might actually cost me in the long run. So we've really got to factor that into your goals, where you're heading, what your life's going to look like over the next 5-10 years to work out the timing of these things as well. On to some investment strategy portfolio. Why is that not showing me everything? That's all right. There we go. So portfolio optimization. So this is one of those things where people start looking at this at the end of financial year as a great time to review their investment portfolios. So this falls under both your superannuation and your external things in your own names, trusts, companies, wherever they might be. And at Apt, we're really lucky. We've got an in-house investment team and they will stay on top of the investment markets. So we are always reviewing our clients' portfolios throughout the year. And it's not just an annual rebalance to see where we sit at the end of the year. We should be doing this throughout the year, but often end of financial year does create that point where people will want to look at it. So it's a good time to review things, ensure your asset allocation aligns with your goals, not your mate's goals, not your parents' goals. People that are 20 are going to have different investment time horizons to people that are nearing retirement. And the risks should be that you're taking with your investment should be slightly different. So taking account of all of that, making the necessary adjustments, and effectively taking the risk that you need to take to get to where you want to be and that you're comfortable with. That's a really important part of it. As I said before, it's not just about considering what's happening this year, but it's over the next few years. You're talking about selling down, potentially triggering some capital gains. But if you know that you're going to have a work change in the next couple of years, or you know you're about to retire, could you delay that sale a year or two, and potentially trigger that gain in a year where you're not going to have as high a taxable income and therefore save some tax? It might mean you cost yourself a little bit more this year, but I'm pretty happy to cost myself 10 grand in tax this year if I'm going to save 100 grand over the next 10. So it's looking at that in a longer term point of view of how these things will work, and not holding the wrong assets for too long. So yeah, you might be better off delaying that sale, but if that investment's going through some major issues and it's not really performing, it might actually cost you more than the tax just holding on to it. And so you got to look at this of not just the tax lens, but also the portfolio as a whole and the risks that you're wanting to take over a period of time. So considering the capital gains timing, whether to realise gains this year or delay, any opportunities to maybe offset gains you've already had this year with potential losses. I talked about red flags from the ATO. Don't just trigger a loss and then rebuy back the same shares. They're not going to like that. But you could buy something similar. You're not going to sell ANZ and buy it back, but if you wanted to buy some other shares to replace it, reset your cost base, all those things are perfectly legitimate and ways to help reduce things and get that portfolio optimized over a period of time. Structure does play a very important part of this as well, though. So you'll hear people talk about superannuation, and I know some people don't trust superannuation because the government has a knack of changing the rules quite regularly on us. But they've just announced changes for everything else as well recently too. So we sort of deal with the rules as we have them at the time. And you look at it and go, well, superannuation under 3 million, you're talking about a maximum tax rate of about 15%. And if you hold those assets for more than a year, the gains is about 10. And if you're in retirement and in that pension phase, it's 0. I'd be pretty happy to have most of my assets in a 0 tax bracket if I could. So using these things, trusts, I know Rob will talk about this in a minute, and I know there's potentially some changes here that will impact some people. But we can't just jump at it and make the changes now. We've still got a full year of benefits of the current structures, and then there's time for us to adjust. So using the different structures, if we can get it out of your name, if you're in high marginal tax rates and we can try and save some money, you can effectively have the same investments in your super as you can have in your own name, but you're paying less tax on the earnings. But there is a balance. People will often talk about superannuation as a big one, and investments. But if you're 20 years away from accessing your super, you don't want all your money in there because it doesn't allow you to live the life that you want to live. And we talk about our clients living a good life over time. And so locking all your money away and living off rice and beans is not what you want to be doing. So you want to have that nice balance to things. And as I said, happy to pay a little bit of extra tax now if it means in the long run you're saving money. So I think the structure is really important, how we can use trusts, how we can use companies, but also not overcomplicating the situation. They have their place, but there's costs involved with them, and it's got to be a benefit to you. So they're a hot topic at the moment, but realistically, we want to get you the best investment returns, and then look at the tax savings we can get associated with that too. It shouldn't just be all tax related. So I think that probably covers that. I'll throw over back to Rob on the debt management.
Yeah, so this is an area that often doesn't receive the same focus as investing or tax per se, but it does underpin everything else. And I think, again, it's that responsibility to kind of review what's happened in the current year and what the future years are looking like as well. So end of financial year is a useful opportunity to step back and look at your overall position, and particularly your cash flow over the next 12 months as well. So again, existing clients will know this from the work we've done together, but ensuring we've always got those cash buffers in place. And again, in volatile markets, like we've seen over the past 6 months, having that certainty is extremely important, especially if there's capital outlay or expenses that are known that are coming up. And even if expenses occur where they're not known, they know they've got that buffer in place. So again, end of financial year is an important reset point from that perspective. In terms of kind of high interest savings and offset accounts and so on, again, depending on what stage of life you are, there's kind of a number of ways to kind of structure this, and again, considering where you're at and what's most appropriate for you. But from times like, with a high interest savings account, for example, if you have one partner working and one who's not, kind of structuring the account so that they're in the lower taxpayer's name. If you are older and in retirement, or even at any age, ensuring that you've got accounts that are in joint names in partnership to kind of appease any estate planning issues, and always ensure that the spouse has access to money as well. In terms of what's most important to you, again, this is where the personal advice kind of comes in. But often we've got, as I said, and especially after this budget proposal, the home is a tax effective place to invest. So if you've got non-deductible debt, it is often in your interest to start paying that down and reducing the amount of interest that you're paying on the loan. If you've got your mortgage under control, or you're expecting a capital receipt at some point in the future, or you have plenty of surplus cash flow, if you're working, that's where superannuation can definitely start to work in partnership with that. And again, some people might go down the tax effective route and then be happy to kind of pull money out of super once they've met a condition of release to pay down that non-deductible debt as well. So that's where, as their advisor, we're sitting down and we're working out from a cash flow perspective what's affordable, what is not taking on too much risk, and what's suitable for each individual client. Again, as we've seen, depends on what part of life you're in, but the increase in interest rates, obviously, if you have debt, this is having an impact on cash flow, and whether or not some investments, as Matt alluded to earlier in the call, are still suitable for your position as well. Are they providing an income? Is there a tax benefit? Is the overall return worth managing that investment as well? On the flip side, again, as Matt brought up before, you don't want to be living off rice and beans. We've had 3 interest rate rises. Well, that typically is creating additional income for our retiree clients or clients in a kind of higher cash position, which again, may create other opportunities for them to utilise some of that money. So regular review is very important, and that's why we look at the end of financial year as a useful opportunity to really step in and do that. Again, just to kind of summarise, in the current environment, when we are having this volatility and little changes, big changes, small improvements can have a meaningful impact. And getting this foundation right really creates the flexibility across all the other strategies that we're kind of putting forward today.
So protecting and growing wealth. So off the back of the cash flow, debt management stuff that Rob's just run through, it's important to get your foundations right. Some of these things are pretty vital. We can have the best plans in place for people, but if the foundation's not there, if the fallback's not in place for you, it can collapse pretty quickly. So there's a few things that sort of flow into reviewing your cash flow and all your debts and just your expenses in general that come into play here. And insurance is one that I'm passionate about because I've seen the impact that it can have on families, both having the policies and not. It's one of the unfortunate parts of our job is we see the impacts of illnesses and injuries on families and what that can do when there's, a primary breadwinner in the family that's out of action for a while. And while I'm passionate about it, I'll admit I absolutely hate paying premiums, and I'm sure everyone does. And to be honest, it's something that we're hoping we never have to claim on. And so it's why it's important to actually review these things regularly. When you've just taken on a mortgage and you have a young family, I know it myself, I've got 2 young kids myself now. My insurance needs are at an absolute peak. I've got to think about funding private school fees, or if that's what I want to do. I've got to think about the mortgage, making sure that they're okay for the next 18 years of their life, and if I'm not around. And so having these things in place gives the family that peace of mind and that fallback, but it is not a set and forget. This is something that, as I said, it's at a peak right now, and I will review these things. And realistically, what I'm hoping is I'm reducing that cover every year as I have maybe other investments building. It's one less year of school fees to worry about, mortgages come down, all of those sorts of things. But reviewing how you pay for these things can be a powerful thing as well. So some of them, on the insurance front, some of it can be funded through your super, some of it can be funded personally, and there's different tax advantages to each. But you can also bring it forward. You can pay the premium. You could get to this time of year and try and pay the premium as an annual amount, get all of the tax deduction this year, which is a pretty handy thing to get in if you can. And so reviewing these things on a regular basis, both from a tax point of view, but just a general cash flow management point, is a really important part. And then also the other bits and pieces. So, your wills and estate plans. Again, lucky to have an internal wills and estates team that can help our clients. But it's a really important part of the estate planning process, just making sure that all your ducks are in a row. The other part of that, though, is estate planning is not just about the document and making sure that's in place. It's what are you wanting for your family or your legacy? Not everyone's got necessarily kids that they want to leave it to. You want to enjoy your life, spend your money, and leave it however you want to. But you've got to make sure that you've got these plans in place. And one of the things we're seeing more and more now is a bit of the bank of mum and dad, and the risk that kids can actually present to you in your own retirement goals or long-term lifestyle. And so something we're seeing more and more from our clients is once they know that their retirement's on track and they know that long term they're okay with the money they've got in their superannuation and their investments, and they're going to be able to live the life that they want, it turns to, well, what are the risks to this? And one of them is kids. What happens if there's a marriage breakdown? What happens if they need to move back in for a little period of time, or they lose their job? And so all of these things where we're now starting to get people starting to do super contributions on behalf of their children. And you get the kids get the upfront benefit. They get effectively a tax deduction for it, but you're also securing their long-term future as well. So there's the super aspect. There's even the aspect of insurance. Do you pay some of their insurance premiums? We've seen that before, and while it's not something, again, that we like to think about, it is a pretty handy thing to do. So estate planning is more than just the document itself. There's a number of important aspects to it. The asset protection piece as well. So we've talked about trusts and companies a little bit, but they go beyond just a pure tax vehicle. That's often how they're sold, to make it sound as it's a really attractive piece. But one of the key benefits really is on that asset protection. Are you self-employed? Do you run your own business? We probably don't want too many assets in your direct name. We're trying to protect this money for you, your family, making sure that you can have a long, happy life. But all of this has to work with your long-term goals. So, at Apt, I think most of our advisors will say, the goals are a really key, important part of what we do. Running through those, making sure that everything's on track and how this all fits in for you. So we want to make sure that ultimately your plans in all of this is tailored to helping you achieve the life that you want to live. Rob?
Thank you. So I just wanted to kind of go through some of what's come through in the federal budget. To be frank, a lot of it is more forward-looking, and so we'll go through that in a moment as well. But essentially, from the federal budget perspective, like the key takeaway this year, a bit of anticlimax, there's actually been quite minimal change that affects end of financial year 2026 strategies. So up on the screen, you can see the personal tax rates are unchanged for FY26, and some of the tax cuts that will come in from the 1st of July. There is a bit of an opportunity to bring forward deductions and defer income. Again, as Matt was talking about earlier in the session, what is the benefit of that, and actually calculating so you're not delaying an important decision in the hope of a small tax win, but it's thrown out other plans. So again, ensuring that we're looking at things from a holistic perspective. This year, as I went through before, the concessional super cap remains at $30,000, and those contributions are still highly relevant. And the year, essentially, you need to go back and check if this may be appropriate for you, is that 2021 balance. And as I said, it's reasonably easy to find now through your MyGov. Medicare levy low income thresholds have increased, but that was already reflected in financial year 2026. And Division 296, which again, until all those budget proposals are passed, is a bit of a recent example of the media getting a hold of something, putting fear into our clients, a number of variables being considered, and the actual legislation that got through looking quite dissimilar to the original proposal. So again, with the other budget proposals, it's now looking lesser of a concern to what it may have done and been to clients when the proposals first came out as well. With 296, again, as we're working through with clients at the moment, there is still time to work through a number of those decisions and see when these budget proposals are put in as well. Again, for the moment, capital gains tax and negative gearing remain unchanged for this year, so that 50% CGT discount for capital gains remains. And again, for this year, the $20,000 instant asset write-off is still there as well, but it's not guaranteed for small business, and that's not guaranteed kind of into future financial years as well. So overall, this is a relatively stable year from a policy perspective for what's currently in place, meaning the focus is really on applying existing strategies effectively, but also looking at some of these changes, which Matt's going to go through in a moment, which is where the future planning opportunities really sit.
Yeah, so I'll finish up here, and it's really that planning window that you've got and why it matters. And so from next year, there's a couple of things you can see on the screen there, and then really most of those changes will come through from 1 July 27 and on. But planning shouldn't just be an end of financial year review. It really needs to be something that's an all year round. It's important to remember, these changes while they're coming through, and there's, tax cuts, CGT changes, tax reforms. We still don't know 100% what they are, and we should get some clarity on those over the coming months to really start planning that out. But there is a bit of a planning window on this that will come through where sequencing your decisions is going to be really important to add some real value to you. So there's the restructuring of trusts potentially in the future, depending on what actually gets through and whether that needs to happen. The negative gearing impacts. So people thinking about property investments. There's a lot of talk about it being more of a commercial property market now than a residential. But often when people are the most scared and fearful is often the best time to be jumping in. So we've got to weigh up all of these things as a benefit over time. But existing structures, we don't want to be jumping at shadows. You can't make changes now. We have restructure windows that'll be open for us. Again, we don't have 100% clarity on what those restructuring windows are, but there will be time for us to restructure where needed with some CGT relief so that we're not adversely impacted. But I think one of the key things here is just it's reviewing this on a regular basis. We talk about it as end of financial year planning because it's the hot topic now, but this is all stuff you should be doing or considering throughout the year. It doesn't need to take a hell of a lot of your time, but often things like I talked about investments earlier, and sometimes if you've got structures or you're looking at paying off debt or you're looking at making super contributions, if you're selling your investments and triggering a capital gain in June, you've had 12 months of income from those shares that you might have had, plus then you're selling down and getting a capital gain. So your income's at a peak, and maybe the better time is actually to sell in July before you've received any income and transferring into those lower tax bracket entities at the start, and then getting that income flowed through into those. And some of these investments, just using shares as an example, you don't have to actually sell it. It's treated as a sale from a capital gains tax point of view, but you can transfer from yourself to your trust, from yourself to your super funds. And you can keep the same investments, but move them into a lower tax environment, provided you're still under those rules that Rob said. So I think it's a really important part just to be considering throughout the year rather than just defaulting to the end of year. There's always a bit of a rush, but it's a really important part. So that pretty much wraps us up. So thanks, everyone. I know it can be a pretty broad topic, the end of financial year. So there's a lot of areas to think about. We've got a bit of a Q&A now, so if anyone's got any questions, there is a Q&A button there for you to pop them in. We'll try and get to as many as we can, and we can also take them offline if need be as well. So if you want to pop anything in, go ahead. One of the questions we've had throughout was just around super contributions. and it was the concessional contributions. They did change a number of years ago, and you used to have to pretty much do it via salary sacrifice, and some self-employed people could make lump sums and claim the tax deduction later on. These days, that's pretty much open to everyone. So if you're unsure whether you can really afford to do the contributions throughout the year and you'd rather have that cash flow, you can just have your default contributions going in. And then in June, like now, you can potentially make an extra, and just using an example here, but you could put $5,000 into your super fund, and then you just lodge a letter with your super fund to say, I'm going to claim a tax deduction for it, provided you're still under that $30,000 limit that Rob mentioned. And that works exactly the same way. Slightly delayed benefit because you get the refund of that tax when you do your tax return, versus if you're salary sacrificing, it's basically the after tax or before tax money that's going in. So you're getting that benefit immediately. But there is a bit of a balance there.
Might just jump in, Matt.
There you go.
Put you on the spot, but something that I often hear from clients is, we have cash available, we're approaching retirement, and essentially, what do we do with this cash? So, what are some of the things to consider? If you don't mind, just running through a few of those and how you structure advice to clients and what's important to consider.
There's a bit of a sleep at night factor to consider in all of this as well, and some people are quite happy taking quite a bit of risk, and others would rather having the money sit under their mattress, earning nothing but just knowing it's there. So it can change depending on the client in front of you. But one of the defaults that most people will think about is their debt, paying down, and I'll put investment properties and investment related debt to the side because tax deductible, but it's the non-deductible primary residence debt. It's often one of the key considerations. You're probably getting a 6% interest rate on your loans or thereabouts at the moment. And if you put 20 grand into that, it is a guaranteed 6% return that you're not taxed on. If you somehow found a 6% bank account that was paying you 6% interest, you would then be taxed on that at your marginal tax rate. So the net earnings is less. So really, if you're going to invest, you need a better return after tax. So there's that aspect, but there's also the aspect of going, well, if I've got 20 grand, for example, and I could put it into my super fund and claim a tax deduction for it, it might be a 15 to 30% benefit for some people immediately, versus paying 6% on their home loan, plus then that money is locked in their super, earning at a low tax environment of 15%. And if you're not that far away from age 60, when you can first get access to your money, it's actually not a bad option, because you could, let's say you're 57 and you go, oh, let's potentially maximize these contributions. I'll get a average of a 20% benefit up front in the total tax savings, and then I'm only costing myself 6% per annum on the interest by not putting it on my home loan. That is a really good strategy, because that will grow to the point where when you've got access, you could always pull it back out if you wanted to and clear the debt later on. So there's a bit of a balance there. Approaching retirement, you're not necessarily going to be taking on more debt to invest. Probably takes on a bit too much risk, but I'd say the key ones are probably, what's going to help you sleep at night, realistically. Investing in most cases over the long term is going to be better, but there's a balance here, and you've got to be comfortable with what you're doing.
As you said, that's where that sequencing really comes in with the advice, and why we have personal advice to different clients. It's not a one-size-fits-all approach at all.
Yep. Rob, there is a question in here from an attendee. It's, can you explain when it might be worth doing a transition to retirement before the end of financial year? So the old TTRs that we used to have, not as lucrative as it used to be, but still pretty good.
Yeah. So definitely not as prevalent as what we've seen in the past, but essentially with these, especially with higher kind of income taxpayers, it can create an opportunity where you're essentially getting money out of superannuation, and then you've got cash available to then make some of those contributions back in. So it can be especially suitable, so if you had some of those catch-ups available to be utilised, that essentially you've got that cash that you may have not had available, maybe wrapped up in other things. You can get some cash out and then essentially recontribute back into super, netting the tax kind of benefit there as well. So good question. As I said, we definitely don't see as many transition to retirements anymore. Now they are taxed at 15% inside super, but it's a good question.
They're still handy in a couple of scenarios. You get the people that are maybe they've got enough to pretty much retire, but they want to keep working for a few years, but they're reducing their workload. And so the super they can start accessing up to 10% of their super fund if they want to per annum to substitute that or supplement the income, make sure they're still getting enough to get by. But yeah, the key one that you see a lot, and you don't have to be a high income earner. There's plenty of people in that 30% tax bracket earning $60,000-$70,000 a year that potentially benefit from being able to pull some money out. And it sounds crazy. You basically take money out of your super here and put it in over here, and you get a tax deduction for it. Yes, the earnings in the fund are still taxed at that point, but you're potentially getting a tax benefit from it just by moving your money around in a bit of a circle. So still potentially very beneficial, but the old 0% tax days that they allowed from 55 for that, long gone.
Fair to say that the goalposts are definitely narrowing on the purpose of superannuation. And as I said, we still think there's plenty of parameters where it's very beneficial. But again, it's important to be across all these changes as they come through.
Yeah, and there's a reason why financial advisors do say superannuation is one of the best places, and it's almost purely to do with the tax. If you can look at it and go, we have the same investments, where are we going to get the best return? If I'm paying less tax in one of them, then that's the better environment to hold it if I can. So it comes down to that. It's just that access balance. If you're still young and a long way away from accessing, you probably don't want to lock it all away. So it's probably relatively rare that I'd get a 35-year-old that I'm maximising super contributions for, because it's just so far into the future. There's a lot to play out. But once you're getting closer to access, it starts to make a lot of sense. If there's anything else, if anyone wants to pop in, Rob, can you see any at your end?
No more questions. So if you're happy, we'll wrap up, Matt.
I'm happy to wrap up. So everyone, if there are any questions, if you're an existing Apt client, please reach out to your Apt advisor. They're more than happy to help. This is a time of year where we're doing this sort of stuff a lot. If you're not an Apt and you're just wanting to have a quick chat, you can reach out to Rob or myself. We're happy to run through, and if there's any specific questions as well, I know some people don't necessarily feel comfortable putting them in chats. I know it's a bit anonymous here, but feel free to put them through. We've got the info at aptwealth.com.au, and Rob and I will be reviewing those over the next little while, and we can come back to you where appropriate or set up a time to chat in more detail if needed. So I think that's pretty much it. So thank you everyone for your time, and let you get back to the rest of your day.
Yeah. Thanks very much, everyone.